Okay, our next topic. Topic for today, loans receivable. Module 10. So in Valix, this is chapter 7, loan receivable. Okay. So first, let's define what is a loan receivable. Of course, it's still part of assets. We recently finished topic on notes receivable. So we are still on receivables, this time loan receivable. Loan receivable is a financial asset arising from a loan granted by a bank or other financial institution to a borrower or client. So for the perspective here, since loan receivable ito, we are either the bank or a financial institution who lends money to a client or to a borrower. So usually, merong mga may short-term loans rather, meron din long-term loans. Long-term meaning has to be paid for a period of years or several years. So in financial accounting, how do we measure a loan receivable? Initially, we record or we recognize it at fair value plus transaction costs. Kindly take note. Transaction costs that are directly attributable to the acquisition of the financial asset. When we say fair value of the loan receivable, usually it is the transaction price or the amount of loan that you granted, right? And then transaction costs directly attributable to the acquisition of the financial asset. Kasama dito ang direct origination costs. So it should be included in the total value of the loan receivable. So we're going to discuss later on ano ba itong mga direct origination costs, no? There could also be indirect origination cost. If it's indirect, recognize outright expense. Again, if it's direct, recognize as part of loan receivable or capitalized. And then indirect origination cost, outright expense. Then subsequently, how do we measure loan receivable? So according to PFRS 9, if the business model is managing a financial asset is to collect contractual cash flows, amortized cost siya. Similar to notes receivable, no? Yeah. So therefore, amortized cost using effective interest method. Subsequent measurement. What do we mean when we say amortized cost in the case of a loan receivable? So you have the measurement, initial measurement, fair value plus transaction cost, minus any principal repayment, plus or minus cumulative amortization of any difference between the carrying amount and principal maturity. So later on, with a problem, mas madali natin ito maintindihan, no? Minus the reduction for impairment or uncollectability. So similar to a note receivable, we also measure the probability of loss or impairment for a loan receivable. If that's the case, then we need to recognize the expense, charge to profit or loss. And now the direct origination fees. So of course, when you borrow from a bank, di ba, meron yung mga fees for allowing you to lend. Pero for this case, sabi ko nga, ang perspective is we are the bank. So we usually charge fees for what? Example, we need to evaluate a borrower's financial condition. Di ba? Nagkakandak ng credit analysis. What else? Evaluate guarantee, collateral, other security if there is such required for a loan agreement. We also have people who negotiate the terms of the loan, prepare the documents of the loan. Ayan. So those are what we call origination fees. Now, how do we account for them in financial accounting? How do we recognize them? Kindly take note, origination fees received from borrower are recognized as an earned interest income, amortized over the term of the loan. However, if the origination fees are not chargeable against the borrower, then it is considered direct origination costs. Deferred din siya, amortized over the term of the loan. So, to further explain, let us consider the illustration. Global Bank granted a loan to a borrower on January 1, 2019. The interest on the loan is 12% payable annually starting December 31, 2019. The loan matures in 3 years on December 31, 2021. Okay? So you have the principal amount, 5 million. Origination fees received from borrower, 331,800. So again, we recognize this as an earned income amortized over the term of the loan. And then we have direct origination, 100,000, deferred and amortized as well over the term of the loan. So to get the initial carrying amount of the loan, 5 million, we deduct the origination fees received from borrower, then we add the direct origination costs incurred, 4,768,200 is the initial carrying amount of the loan. And then how do we record it? In our books, journal entries on January 1, 2019, loan receivable equal to the amount, 5 million. Credit cash. So this is the case kasi we are the lender. To record origination fees received from the borrower, debit cash, we received it as payment from the borrower. You credit unearned interest income during the 31,800. To record the direct origination costs incurred by the bank, so other transaction costs, no? Debit unearned interest income, credit cash. So for this case, what happened? The normal balance of unearned interest income, can you take note, is credit balance. So 331,800, nabawasan siya ng 100,000. 231,800 now, credit balance ng unearned interest income. And according to our accounting for origination fees, we need to amortize over the term of the loan. So when you say amortize, hindi mo siya lump sum na i-recognize as income. You need to defer and recognize it appropriately depending on the period. If we're going to use the effective interest rate method, therefore, we need to compute for the effective rate. So hindi given dito kasi we have the unearned interest income. This one is supposedly the interest. So there's no rate given here. Because of that, we need to compute for the new effective rate. Kasi di ba ang naging value na ng loan natin is 4.7 million. Itong 5 million supposedly 12%. Pero naging carrying amount na natin is 4.76. This is like the present value as well. 4,768,200. So we need to compute for the new effective rate. How are we going to do that? Yeah. We take note, the carrying amount is lower than the face amount. So carrying amount is 4,768,200. The face amount is 5 million. Therefore, there is what we call a discount. So in a loan kasi there could be premium or discount. If the carrying amount is lower than the principal amount, then there is a discount. So, kapag discount, as a rule naman, in terms of the interest rate, no? Lagay natin. As a rule, the new effective rate, of discount versus the nominal rate, mas malaki naman yung effective rate versus the nominal rate. Okay? The nominal rate is what we see here in the problem, 12%. So therefore, if mas mababa ang carrying amount, the effective rate must be higher than 12%. So for this case, yeah. According to the problem, after considering the origination fee received from the borrower and the origination cost, the effective interest rate is determined to be 14%. Yeah. Actually, dito nag-trial and error lang siya. Na? Yeah. So, to get the 4.76800. And then once you have the effective rate, then you can prepare the amortization table, similar to the table that we've been using. Or similar siya sa notes receivable, it's just that we are accounting for amortization. This one is actually pertaining to the unearned interest income as well. Okay, so what is this amortization table? How do we compute for this one? We have computed the carrying amount, 4,768,200. The interest received pertains to the nominal interest, 10%, which is 12%. And the interest income is the effective interest to be recognized, 14%. So 4,768,200 multiplied by 14%, it's equal to 667,548. The interest received, of course, it pertains to 12% times 5 million. Kaya 600,000 siya for a period of 3 years. Yeah. So if the interest income is 667,548, compare it with the interest received. Therefore, part of it is amortization of the unearned interest income, 67,548. You're going to add that to the carrying amount. Therefore, the new carrying amount as of December 31, 2019 is 4,835,748. Multiply again by 14%, 677. Compare with the interest received, the amortization for 2020, 77,005. Carrying amount, add that to the previous balance, and so on and so forth. Until at December 2021, you will have a 5 million balance, which is equal to the principal of the loan. Yeah. Okay. For journal entries, how are we going to recognize this? On December 31, 2019, we received interest payment, or we collected interest from our borrower. So debit cash, credit interest income, 600,000. For the amortization of unearned interest income, take note the balance of our unearned interest income is credit balance, right? So to recognize the amortization, since this is additional income, you debit unearned interest income, credit interest income. 67,548 based from our table. The following year, so how are you going to present this one? Itong unearned interest income in the statement of financial position. Of course, loan receivable, 5 million, non-current. Unearned interest income, the balance, so we have 231,800 minus 67,548. The balance is 164,252. This is a contra asset account. So you deduct it from the loan receivable carrying amount to get the carrying amount as of December 31, 2019, 4,835,748, which is also equal to our carrying amount in the amortization table. Okay. So journal entries on the following year, 2020, we again collected 600,000 debit cash, credit interest income 600,000. Then recognized amortization, debit and earned interest income, credit interest income. From our table, we computed 77,000, 5 pesos. In 2021, finally, we collected again 600,000 and earned interest income, amortization 87,247. And we collected the loan in full. Debit cash for 5 million, credit loan receivable 5 million. So as of December 31, 2021, both the loan receivable and the unearned interest income should have zero balance. Okay? And then to further understand, then we need to solve some problems on loan receivable. Now let's talk about as well the impairment of loan. Like we mentioned, part of amortized cost, di ba, we add or deduct any impairment. When we say impairment, it is a loss, allowance, because it may be uncollectible. May risk, di ba, pag tayo ay nagpapautang. So it is a requirement by PFRS 9 that we shall recognize a loss if there's a probability for it. So how do we measure impairment? Yeah. We have what we call considerations, probability weighted average, or time value of money consideration. The credit loss will be discounted or reasonable and supported information is available. Alaman lang natin na, halimbawa, yun nga, the borrower, tumakbo na siya. No? So we need to recognize impairment if there had been such evidence that there is a probability of loss or possibility of loss or uncollectibility. So how do we measure the impairment loss? Of course, it is the difference between the carrying amount and the present value of future cash flows discounted at original effective rate. Yan. We use the impairment, we debit impairment loss account, and then allowance for impairment yung credit. Or pwede namang direct na babawasan mo na yung loan receivable and no longer use an allowance account. So let's have an example here, illustration. International Bank loaned 5 million to bank card company on January 1, 2017. The terms of the loan require principal payment of 1 million each year for 5 years plus interest at 10%. The first principal and interest payment is due on December 31, 2017. Bank card company made the required payments on 2017 and 2018. However, during 2019, bank card company began to experience financial difficulties and unable to meet the required principal and interest on 2019, December 31. So the company, International Bank, assessed the collectibility of the loan and has determined that the remaining principal payments will be collected but the collection of interest is unlikely. So okay, makakolekta pa yung principal pero yung interest baka hindi na. So the loan receivable has a carrying amount of 3,300,000, including the accrued interest of 300,000 on December 31. The international projected cash flows from the loan on December 31, 2019 as follows. So ito na lang yung mga kolekta. 500, 1 million, 1.5, total 3 million, which is equal to the principal of the loan. Using the original effective rate of 10%. So again, ang sabi natin, how do we measure impairment? We get the present value of the estimated future cash flows. We have here the future cash flows. Next is we need to get the present value. Given naman yung mga periods natin, present value, factors. So on December 31, period of 1 year from 2019, 2020, that's a period of 1 year for 2019, from 2019. In 2021, that's 2 periods. 2022, that's 3 periods from now, from 2019. So we use the present value factor as follows. And to get the summation total, ito na yung ating present value of discounted future cash flows. 2,407,900. And then, we compare it with the carrying amount of the loan. According to the problem, the carrying amount is 3,300,000. So therefore, the impairment loss that we will recognize, 892,100. To record the impairment loss, debit loan impairment loss, credit accrued interest receivable, kasi part of the carrying amount is 3,300,000. So definitely we have to remove that 300,000. And credit allowance for loan impairment, 592,100 for the balancing figure. How are we going to present it in the financial statements? Of course, the loan receivable, we can collect it, 3 million. But we have an allowance for loan impairment, 592,100. So the carrying amount of the loan is 2,407,900. To prepare the entries, ayan, on December 31, 2020, we received the cash. Debit cash, loan receivable, 500,000. To record the interest income using the effective interest. So take note, di ba? Itong allowance for loan impairment, we amortize it as well. And we charge it to interest income. So debit allowance for loan impairment, how did we arrive at this amount? Kasi the effective rate is 10%. So 2,407,900 times 10%, 240,790. So interest income credit, pero we are charging allowance for loan impairment, 240,790. The following year, 2021, 1 million, we received the collection. And then, to record the interest income, loan receivable, you get the carrying amount, and then whatever is the carrying amount, we multiply it by the 10% ulit. Ganun pa din. So the loan receivable on December 31, the balance that we have, 3 million minus 500, it's 2.5 million. Allowance for loan impairment balance, 592,100 minus 240,790. 351,310. The carrying amount as of December 31, 2020 is 2,148,690 multiplied by 10%. That is our interest income, amortization, charged to allowance for loan impairment account. And finally, on December 31, 2020, ganun pa din. We collected 1.5 million. And then, we get the amortization of the interest income of the allowance for loan impairment. We get the carrying amount on December 31, 2021, multiplied by 10% effective rate. So this is our interest income. That's it. And we also have additional problem here. Now, another illustration for impairment of loan.